Hello students, I am Ranjitha B.R. I am going to present Introduction to Financial Accounting, and in this video I am going to present System of Accounting and Accounting Standards. System of Accounting is recording the financial transaction in the books of accounts is generally known as bookkeeping. It can be divided into two types, namely single entry system of bookkeeping and double entry system of bookkeeping. So, what do you mean by single entry system of bookkeeping? It is a system of bookkeeping under which a complete record of each and every transaction is not kept. Under this system, for some transaction, both the aspects are recorded. For a few transactions, none of the aspects are recorded, and for the most transaction, only one aspect is recorded. As only one aspect is recorded for most of the transaction, the system is called as single entry system. Now it is popularly known as accounts from incomplete records. It does not record twofold effect of transaction. It is an incomplete, it is unscientific, as well as inaccurate method of bookkeeping. So, double entry system of bookkeeping. Double entry system of bookkeeping is a method where both aspects of transaction are considered and recorded. This system refers to a set of rules for recording financial information in an accounting system, in which every transaction affects at least two different accounts. As per this system, a financial transaction affects two aspects, that is, of receiving the value and giving the values, or debit aspect as well as credit aspect of it. The system of making two or double entries of equal value in two different accounts in opposite side in the books of accounts is known as the double entry system of bookkeeping. So, rules for the debit and credit. English system. In the English system, every transaction has twofold effects for the same amount and recorded at two places, that is, two accounts. There are three types of accounts under English systems of accounting. One is personal account, real account, and nominal account. The rule for the personal account is debit is the receiver and credit the giver. Rule for the real account, debit what comes in and credit what goes out. Under the nominal account, the rule is debit all expenses and losses, credit all income and gains. Under American system, two fundamental rules are followed to record the changes. Number one, for recording the changes in assets or expenses. That is, increase in asset is debited and decrease in assets is credited. Next, increase in expenses is debited and decrease in expenses is credited. Next one, for recording changes in liabilities and capital or revenue. So, increase in liabilities is credited and decrease in liabilities is debited. Increase in capital is credited and decrease in capital is debited. Last one, increase in revenue or gain is credited and decrease in revenue is debited. This comes under the American system. So now I'll move on to the accounting standards. The uniform, definite and universally accepted accounting rules developed by International Accounting Standards Committee, that is IASC, are known as accounting standards. Different countries, depending upon the customs, tradition, rules and practices, and prevailing in their nations are adopted and followed. So these leads to misunderstanding, uncertainty, and resulting in scandals and confusion. Accounting terminologies and practices were not standardized, so it was left to the users of accounting to interpret the accounting terms suiting their interest. So therefore, the urgent need to develop universally accepted internationally standardized accounting terminology, commonly known as accounting standards. These are necessary to prevent financial frauds and business failures. It was only in 1973 that an International Accounting Standard Committee was formed with 16 accounting bodies from 9 nations as founder members. The committee agreed to formulate and publish in public interest accounting standards, which are to be observed in the presentation of audited financial statement and to promote their worldwide acceptance and observance. So development of accounting standards in India is carried out by Institute of Chartered Accountants of India, works as the counterpart of International Accounting Standards Committee. The institute has formulated and issued accounting standards of recommendatory nature. These standards are known as Indian Accounting Standards. So let's begin with the AS3. These cash flow statement. This gives a standard for the preparing of the cash flow statement and its presentation along with the financial statements. Cash flow to be classified by operating, investing and financing activities. AS4, Accounting Standard 4. It deals with the treatment of contingencies and events in financial statements. Example, cases in High Court are penalty proceeding under law. Accounting Standard 5 deals with the treatment of prior period and extraordinary events. Debits or credits which arise in a current year or as a result of omission mistakes in prior year. Also extraordinary items like writing off inventories, disposal of fixed assets. It is a prior period of extraordinary items and changes in accounting policies. Accounting Standard 6 deals with the depreciation of accounting. Accounting Standard 7 deals with accounting for construction contracts. Accounting issues of revenue, treatment of advances received, work in progress in financial statements. Types of contracts may be fixed price contract, escalation plus escalation cost or cost plus a fixed fee. Amount and method used to determine revenue recognized. Accounting Standard 8 deals with accounting for research and development. Accounting Standard 9 is revenue recognition, basis for recognition of revenue. When revenue recognition postponed, disclosure of circumstances to be made. Accounting Standard 10, it deals with the accounting for fixed asset. Accounting Standard 11, translation of accounting transaction in foreign currencies in reporting currency. This accounting for the effect of changes in foreign exchange rates. Accounting Standard 12 deals with the accounting for government grants, subsidies, cash incentive, duty drawback and does not include any tax exemption or tax holiday. Accounting Standard 13 deals with accounting for investments and Accounting Standard 14 deals with accounting for amalgamation. Accounting Standard 15 deals with accounting for retirement benefits in the financial statement of employers, PF, pension, gratuity, leave encashment, post-retirement welfare scheme, method by which retirement benefits are valued. Then Accounting Standard 16 is borrowing cost, capitalization of borrowing costs attributable to acquisition, construction or production where qualifying asset takes substantial period to get it ready for intended use of sale. Accounting Standard 17 deals with segment reporting. For reporting of information about different types of product and services of an enterprise and its operation in different geographical areas. Accounting Standard 18 related party disclosure. Relate party relationship and transaction between a reporting enterprise and related party. Accounting Standard 19 is lease agreement, accounting policies for the lessor and the lessee and disclosure in relation to financial lease and operating lease. Accounting Standard 20 is earning per share, principles and determination of earning per share, comparison between enterprises. Accounting Standard 21 deals with consolidated financial statement of parent and subsidiaries. Accounting Standard 22 is method of determination of amount of expenses or saving relating to taxes on income in respect of an accounting period. Accounting Standard 23 is for investment in associates. Accounting Standard 24 is discontinuing operations. Disclosure of pre-tax profit or loss from activities attributable to discontinuing operations. Accounting Standard 25 is interim financial reporting. Accounting Standard 26 is for intangible assets. Accounting Standard 27 is financial reporting of interest in joint ventures. And Accounting Standard 28 is impairment of assets, equity or debt listed, turnover exceeds rupees 50 crores. Thank you one and all.